All right, hello everyone, and this is a panel on insurance in the crypto markets. I have experts up here, from brokers to underwriters to custodians, who will explain this market. It may not sound like the most exciting thing, insurance, but these are sort of the ninjas of insurance in that they're creating a whole new market. They're learning how to price new kinds of risks. And if anyone's considering getting into it or running an exchange, this is definitely something that they're having to think about right now. I would first like everyone to just explain what they do in as non-technical terms as possible, starting with Alex right here.
Sure, yeah. So I'm Alex, co-founder and CEO of KnØx. We are a cryptocurrency custodian with a particular focus on insurance. One of the things we do is when a customer comes, we can insure up to the full value of the assets held in our custody. That's the long and short of KnØx. Jen.
Jennifer Hustwitt with Marsh. Marsh is the world's largest insurance broker, 30,000 employees globally. I run our fintech and digital asset practice globally, as well as focus on the digitization of insurance processes and contracts. We work with digital asset clients across the ecosystem, from exchanges to funds to trusts to security platforms and the rest.
Hi, I'm Chris Liu. I'm an insurance underwriter with AIG. We're a small insurance company. Maybe you've heard of us. I head up the cyber insurance practice for financial institutions, so that's all banks, insurance companies, asset management, private equity, hedge fund, and I've taken it upon myself to be our cryptocurrency industry liaison, if you will. So.
Hello there, I'm Jacob Decker. I work with a company called Woodruff, Sawyer. We're a San Francisco-based firm that is now has offices nationally. I head our financial institution practice, which has increasingly meant that all flavors of fintech, crypto, new versions of traditional financial service companies usually end up on my desk to develop new product and to sort out some somewhat challenging placement issues.
Thanks, everyone. I think it's fascinating, just the notion of insurance in an industry where every article you read has a disclaimer saying, by the way, there's a decent chance you'll lose all your money on this investment. I know that you can lose your money in stocks, which I usually cover, but in this industry, obviously, there's a higher chance of literally losing everything. And I know that most insurance products don't cover that sort of thing, but I'd be interested in what you can actually insure in the crypto industry. I know, Jennifer, we talked about that a little beforehand. If you could kind of run through, as a broker, what can you offer a client who comes in and says, I need insurance?
For crypto, specific to crypto.
Yes.
So it's early days in the insurance market for digital assets. So about 2 years ago, buying really started to tick up. That's not insignificantly aligned with when prices truly started climbing. But the interesting thing to see is that as prices have subsequently came down, insurance buying continued. But the main areas of focus transitioned a little bit. So when we think about risks and what can be insured relative to this space, we think about it in 5 buckets. You want to think about security risk, regulatory risk, operational risk. There's an existential and reputational risk to a certain extent as well. And finally, at the end of the day, theft of digital assets. Each of those 4 areas of risk tie into theft, but by far the largest demand that we see is for theft, both by employees and third parties. Management liability, SEC and regulatory uncertainty around the world certainly driving the second greatest area of insurance, which would be D&O.
Can you insure against President Trump or Jay Clayton saying, we're done with this crypto thing? We're going to regulate it essentially to death. You talk about regulatory risk.
So in a large sense, cat risk drives the industry. Regulatory risk really focuses on investigations. Investigations are insurable at small limit amounts for cryptocurrency. At the end of the day, bankruptcy is an area of risk that can be insured to some extent as well. So sort of the worst case scenario, abolition of a marketplace within the US and the personal assets of directors and investors that are on the table can touch insurance. But realistically, we envision that a lot of the crypto activity would move outside the US in that case. So there would still be an insurance market.
I mean, insurance is consistently discussed as one of the core infrastructure areas that's, insufficient so far. What needs to happen? Like Alex, you've been in this for a while. What needs to happen for insurance to be fully palatable to, large institutions? What are you seeing as far as that risk?
So I think I'll answer also the last question to say the way we thought about the risks that we chose to transfer is as potential consumers of a custodial service. And so for us, we looked into, what would we as potential customers of our own service want to have insured, and came down to really loss, the inability to move funds, and then theft. External theft is certainly something that we sought to insure, but for the reason that Jen stated, internal collusion and internal theft was for us the most dangerous aspect of using a third-party custodian. So this is a counterparty risk that if I were a consumer of a custodian, I could not come to bear with unless there was a backstop specifically against that. And one of the things that we sought to insure and successfully did was ensuring collusion risk for the full life cycle of the private keys. With that done, I think the things that we would really like to focus on in the coming years and that I think are important for institutions will be lowering the price of insurance. I believe it is significantly more expensive to insure digital assets than it ought to be from kind of an objective actuarial sense. And then further the capacity limit. So getting to the tens and then later hundreds of billions of dollars worth of capacity may be necessary as if Bitcoin continues doing what it has done historically.
And Chris, I mean, when you're underwriting some sort of policy, what are the risks that you look at? How do you price them? I mean, what's sort of that discussion like?
Sure. So the main goal is to understand the risk. So it really depends on what you're doing. The way we think about it is it's sort of like a math problem, which I think is probably the best way to frame it for this group. So you have your assets, whatever the thing it is that you have that's of value. You have threats, right? Whatever is the risk or the threat, either people stealing from you, you running out of money, or what have you. The mitigation, so how you protect against some of those things. And then we say what's left over is your residual risk or implicit risk. And then we call it the art of risk, right? So AART, right? You can either accept, avoid, reduce, or transfer. So all of those mitigation components are either you say people, could burn our office down. We don't, we have sprinklers, but beyond that, you're not gonna. There's no other way to reduce or avoid that risk. You have to do business. You have to operate. So then you look at what's left over is your transfer. So we try to engage with companies of all types, traditional banks and insurance companies, and also cryptocurrency companies, understanding what are their assets that they're trying to protect against, what are the threats that they face, what are they doing to protect those things, and then what's left over. And we look at how you can transfer that into an insurance policy. It has less to do, at least in the cyberspace, it has less to do with technology and policy and process, although that is, of course, important. You want to know that there is someone who's in charge, they have the support of the board, they have adequate budget. Technology and policy and process and how you deal with your operations is sort of in that middle part. And then response and recovery is, so when something bad does happen, are you practiced? Do you have a plan? Do you test against it? And really, when you go into a meeting and a client says, we don't have any problems or no risk or nothing can go wrong, that is generally a worse underwriting profile than someone who says, here we've identified all of the bad things that can happen, here are the things that we can do, this is what we need your help with. And it really is a partnership. It's you teach us about your risk and your operation. We will try to work together to design solutions that match up with that risk that you need to transfer.
And Jacob, you work as a broker in this. Well, what are the prices like at this point? Are you finding wide variance? Are people trying to rip each other off in this, given that there's so many unknowns? What role can you play in that?
Yeah, I think there's a perception maybe that some of the pricing might be opportunistic or really high. You can cut that a couple different ways. If anyone who buys traditional financial institution product, which there's a very large suite of product, there is certainly a risk premium involved with nascent new industries where there isn't good spread of risk. There aren't a large set of kind of similar risk profiles out there. Just logically, you can imagine that that's harder to spread that risk. But financial institutions pay pretty large premiums traditionally for insuring against theft, cyber exposure, mismanagement of the company. The premium rates for those are naturally high. They're much higher than they are in a lot of other sectors. So depending on what you're doing with the new tech, if you're operating in a highly regulated financial service environment, premiums may seem a bit high, but often, as that company matures, I think it kind of right sets a little bit what they think is high. So if you're an early stage company, you've just done a seed round and you've now entered into a highly regulated financial service space, that premium probably seems high to you, but you probably don't have a balance sheet. You represent a very high risk. You represent some technology that may or may not be tested. You may not have a real long track record of audits and performance. So it's appropriate probably to have a little risk premium on top of what an analog version of that same industry would do. So depends on who you're talking to. I don't view the premiums right now in the space as being out of what I would expect, frankly, for fintech.
And the way that we talk to clients about it is how do you price an insurance policy is a lot like how you price a car, right? It depends on what you want to buy. If you want something with 3 wheels, that will cost much less than something with a chauffeur, right? So it runs the gamut. And then also, this is a particular space, right? There are no cryptocurrency companies with 10 years of operations, right? It's just, we're getting there, but it's just physically not possible. So not having, robust risk management procedures, not having, you said some balance sheet issues, but then also the other part of it is helping us understand what your assets look like. We go to our credit department and they say, yeah, you have all these assets and liabilities. A good portion of them are digital assets. We don't know how to value them or don't know how to think about what that actually means in terms of your credit risk. So again, it's educating us about what the risks are, and we will then be able to work together to come to solutions.
Yeah, I would describe pricing as both difficult and dynamic, and you want to think about it in 3 ways: the amount of limit that's being purchased, the scope of coverage, and the quality of the carrier.
If Mt. Gox happened today and I hadn't, all my money in it, how much, let's say I had $1 million in it, how would I insure that? Is there a way to, as the buyer of Bitcoin through an exchange that, might have some issues with it, is there a way to insure that? How much would it cost, say, to insure $1 million worth of Bitcoin for a 3-year period with an exchange like that? Does that exist?
I think it's important to make a distinction here. Most of the commercial product that is purchased is for the benefit of and is an asset of the buyer, so the company that purchases it. So we got to be really careful. It seems like there's often this conflation of commercial insurance product almost being represented like some sort of wrapper to a financial instrument, which that's a different animal. When we talk about regulated property casualty, it's effectively a product that backs the balance sheet of the buyer. It's an off-balance sheet funding source, right? So there's underwriting, and to your question earlier around kind of pricing, I'm interested to hear other people's comments on this, but my impression right now is that if you can pass the underwriting kind of thresholds in terms of segregation of assets, policies, procedures, the right mix of risk management, then you can obtain insurance at what is probably going to seem relatively expensive, but it's not that far off from what traditional banks and exchanges and others pay for insurance. If you can't, if you're a Mt. Gox, if you have a lack of certain controls, insurance won't be available to you at any price. So insurance companies are not interested with just trading dollars with a buyer. There needs to be a high degree of comfort that it will be a fortuitous, relatively rare event that leads to them paying a policy limit. If they're collecting 1%, if that's the rate they charge on the asset or on the risk transfer, they need 100 risks at that price to fund the loss. So when you think about that, how many real buyers are there in the market? There's a reason why the pricing is relatively high. This is not a deep market yet for transferring risk.
The insurance that is currently available in the space is cyber, fidelity. Fidelity is sometimes referred to as crime. E&O and D&O. So D&O is protection for your directors and officers' personal assets. So when you're trying to hire a CEO or board members, they can come on and do the work for the company with the confidence that their house is not going to get taken or their yacht in some cases, which varying levels of sympathy there. E&O is for your failure of professional services. So in commercial E&O, if you're a lawyer or you're selling widgets, the threshold is negligence, right? You had to have actually done whatever the negligent thing is to cause harm to your customers. In financial institutions, it's very broad. It's anything that you do. So selling a mortgage, making a loan, paying an insurance claim, or usually you get sued for not paying an insurance claim. The E&O policy responds to lawsuits of customers. So if you put your money with a security firm and they lose all of your assets, you can bring a claim against them or sue them to recoup your damages, and then their professional liability policy should pay for some of that. Cyber infidelity is a data privacy issue and network security issue. So either disclosing data or stealing data, usually of the personal confidential nature as we talk about, or network intrusion, somebody actually going in and accessing something they're not supposed to or breaking something they're not supposed to. And the fidelity crime is the theft of the assets. Employee theft is where this generally comes from, the bank teller who's been putting $1 bills in the middle of $200 bills in the bundles, and then you've come to later find out, right, that all that money is gone, it belongs to customers. They are a regulatory requirement to be insured against that kind of loss. And then there's also on-premises theft and transit theft. We still use telefacsimile as very high tech. So depending on the type of business, whether you're custodian, transfer, software platform, advisor, consultant, right, all of these different types of insurance are going to be either more or less useful for you, and that'll guide your sort of risk management approach to the insurance.
Theft of assets, to your question, from an exchange can be covered in the spectrum of policies that Chris just outlined. It's called the FI bond, it's crime insurance. It's expensive, and we placed the first exchange policy 6 months after Mt. Gox. And it was a 6-month policy and a low limit, and each carrier took a very small piece of it. That's illustrative of some of the exchange policies today. A number of carriers taking very small bites and just putting their foot in, dipping their toe in. But the exchange programs are difficult, but they are available in the market with a lot of work.
Do engineers seem to play a bigger role in this than in if you're insuring your house? Alex, you have an engineering background. Is that necessary? What does an engineer bring to the table? I mean, do you have to get into the lines of code for a new product if you're planning to insure it or custody it? And do maybe some of the old line insurance companies not have that kind of expertise that you might?
So I think certainly one of the things we did when we started KnØx was look at what is the current state of affairs when it comes to custodial services. And one of the perhaps naive points that I came to believe, or that I felt the world was looking at this naively, saying, look, custody as a whole, technologically, is a solved problem. You can do cold storage and it's extremely safe for these reasons. And we felt that you could, in fact, bring technology to bear to do things like substantially reduce the objective risk of, for example, collusion risk. And that is something that we spent a lot of time and money implementing with great R&D effort. Secondary to that, demonstrating that the controls that you have imposed by technological leverage are functioning, and then being capable of making insurance markets understand why you applied that technology, what in particular it's designed to do, and why it is effective at doing exactly that which it is designed to do is a secondary challenge. So certainly from an engineering standpoint, one, technology is something that we applied to reduce the objective risk. And in the broader sense, as engineers, as systems thinkers, we thought through what it would look like to be capable of demonstrating these systems to the relevant parties who would ultimately be taking the risk.
Insurance typically sits either in legal or in finance within a financial institution. The challenge with crypto is that the law and the language around digital assets hasn't entirely been developed, and it varies by jurisdiction. So what we've had to do is, in some cases, bring in technical teams from some of our clients to sit down with the policy language and say, how should we be defining crypto asset in this case? And I think Chris can probably allude to similar examples.
Yeah, no, it's super important. Again, it's not just talking about with our clients what their risks are and the challenges that they face, but it's, do our policies use the right words in them, right? It's a legal document. It needs to be crafted so that it matches the intent, both of what we're trying to sell you and what you're trying to buy. For example, the cyber insurance policy excludes theft of funds, so monies and securities. So if you hack in and you steal money from someone, the cyber policy will cover the forensic investigation and legal and PR in dealing with the hack, and then your fidelity crime policy will deal with the actual theft of the funds. So it's a grant of coverage under one and an exclusion of coverage under the other, and they work hand in hand. So when you, much like you crash your car into your house, your homeowner's policy pays for the house and your auto policy pays for the car, and nobody complains that you don't have one policy, right, that does everything. So working with our insureds to make sure that we're using the right terminology around monies and securities also includes digital assets. Are private keys data, or is it more like money, right? If I disclose a private key, is it more like me throwing money out the window than it is giving somebody, the login and password to your bank account? So some of it is bringing these terms of art and terms of technology into the policy to make sure that it's going to work in the way that everybody intends it to.
And a concrete example would be, how does a crime insurance policy respond in the event of a fork? And what fork events should be covered and not covered? And what is actually occurring when a fork occurs? And are there different variations? In some cases, should it be covered? In some cases, should it not be? So that would be another example when we have to bring technical teams in to assist with the policy language.
Yeah, I can certainly relate to Jen's points about looking at policy language from a technology perspective and from a cryptocurrency perspective. And many times, this is an asset class so nascent that there are even legal definitions that have not yet formed around it. So one is simple as, if in a policy you define Bitcoin and you ask what is Bitcoin, we don't yet have a legal way of saying, Bitcoin is the tip of a chain that is the greatest amount of work relevant to this ancestor block, right? This is not yet encoded in legalese. And so there's a lot of these sorts of terms that even at the moment I would say are, I'm sure in a situation where a court looked at it, we would come to a reasonable conclusion that this is in fact what we meant to define, but the industry still has a way to go. And by industry, I mean even just the legal industry as a whole.
So Bitcoin we can define as BTC, but that's a social construct. It's not a technical construct. So we've had arguments made to us that it should be defined according to row height and block size and whatnot. And so we're sort of on the cusp of how far do you go and how technical do you make these insurance policies.
So insurers might actually write the law in some ways through a back door. It seems like, Hong Kong recently announced new rules, I think for exchanges involving insurance too, and you're obviously having to deal with regulators all over the place. In some ways it seems like, regulators are looking to insurance as a way for them to be comfortable almost with these asset classes. How do you deal with regulators and sort of talk to them and to know that and to assure your clients that this is a policy that's actually going to hold up in court one day? And has it been tested in court in a way that, that actually upholds the way you've written these policies?
Yeah, so to answer the first question, you're absolutely right. Just last Wednesday, the Hong Kong regulators put out a position paper effectively saying if your exchange trades a single security token as some pair, then you will have to comply with this set of regulations. And one of the points stipulated in that was that your custody be insured at a level 95% plus. So a few things there. One, very early on, and we continually update this, we form a thesis about how regulators will respond to this asset class and some of the things that they will do. And we had long ago guessed that in some jurisdictions, regulators will stipulate that insurance is necessary in order to protect the investors of the relevant platforms, precisely because this is a bearer instrument, and once lost is lost. Further to that, however, there is a lot of kind of subjective points to this, in that when you put out a position paper like this, for example, when you say the custody must be insured at 95% plus, that's still leaving out a whole lot of relevant details, because the policy as written, of course, is always written with a lot of different details, and they ought to now get deeper and start describing, what are the particular risks that we think must be transferred in order for these policies to apply. And this is something we're both now and in the future, we'll actively work with regulators to help define.
Yeah, we certainly encourage regulatory requirements for insurance. Jersey, but they will help the insurance industry continue to grow and better cover digital assets. Jersey, Gibraltar, and Hong Kong all have varying forms of insurance requirements, and Bermuda, we think, will go down that road as well in short order. In terms of covered losses, there haven't been any insured theft losses yet. We anticipate that will happen in the next few years. Again, you need to have insured losses in order for the market to develop. It's very young and nascent insurance industry for digital assets.
One thing that I would add, and I mentioned this in the context of both from regulators and from customers of crypto fintech companies. Just like if you're doing diligence on any counterparty, you're not just going to ask, what insurance do you buy, tick the box, and good to go, right? It's a suite of questions to kick the tires. So regulators sometimes have requirements, but regulators' deep understanding in insurance also leaves something to be desired. And often those requirements are, you have to have a couple $1 million worth of fidelity insurance. I never give that same advice to customers if they come and say, hey, we just need to meet a regulatory requirement. I say, well, let's understand there's got to be a meaningful decision about what limit is appropriate. Often the amount that's being required is not even material in my view. So just like if you're a professional investor, you should probably do your own homework. You should ask about insurance. You should ask about a lot of other things. But you should also understand that even in mature financial institution insurance product, it's continually being updated and worked on. It's not like, really, you wouldn't need brokers or people that specialize in negotiating these contracts if it was a commodity, right? These things are constantly being updated. New Supreme Court decision, new state law, case goes a different direction, causes a split between circuits, foreign jurisdiction changes the rules. The insurance contract has to continually be viewed with that in mind and updated. So it's no different for crypto as it would be for any other commercial insurance risk, and that brokers are continually and underwriters are continually trying to improve and adapt and react and make sure that the coverage responds and matches what the intent is. So it gets back to one point, and Chris can respond to this. It's important to have a relationship between the buyers and your carrier. For if that event that has never been contemplated, that isn't clear in black and white, you have a trusted long-term relationship with premium paid into the market that can help get the kinds of outcomes that you want. So it's worth just noting, this is not as simple as how many autos you have, what year, plug it into the machine, pops out a premium. These contracts are quite a bit more complicated and sophisticated than that.
It's interesting there hasn't been legal precedent in this, given that this is an industry that's rife with hacking and fraud and nonsense. Why do you think that is? People have written a lot of policies. None of them have really been tested legally at this point.
Talk earlier.
Outside of ICOs and clear clear depending on the eye of the beholder here, but there was certainly a craze in 2017 that led to a lot of kind of unregistered security offerings or exchanges, broker dealers that were not registered, making a market in what was later deemed to be a security. The insurance market was not real quick to write the types of insurance that applied to that type of risk. It was pretty widely viewed as this is a burning building. We see it just right in your face security violation occurring. We can't write this risk. But there were policies that were written, and some of those have been tested. That's more on the director and officer liability front. There's also been insolvencies. Anytime there's an insolvency, there could be various types of insurance claims that are implicated. So some testing, but to Jen's point, it's a little different in the custody theft space specifically. But there have been some liability claims.
If a large investor is starting to consider investing in cryptocurrency and thinks to themselves, who am I going to call? I'm going to call my usual insurance broker maybe, or my usual insurer. What's that decision like? Should I go to my usual guy and see what he says? Or should I go to maybe a digital native business like yours, Alex, how do you sort of pitch that? If someone says, look, I got my guy at AIG, or I got my, my usual people I talk to, how would you discuss, or, I can custody at Fidelity. Why do I need to go to some fancy new place? How do you sort of deal with that kind of a question?
So, our answer to that question is quite simple. I think also to the previous point, the fact that there have been no claims made is testament to the rigor in due diligence that underwriters apply when analyzing these risks. So the number one outcome if somebody tries to hit the insurance markets to try to bind a policy is to be denied coverage outright. The number two outcome, the number two outcome is to be given coverage but premiums higher than, for example, our own AUC fees, which then for me answers the second question quite readily is, in our case, we believe that specialization there's a reason why specialization occurs in economies, and one of the things that we've been able to do is produce a custodial service so robust with controls that allow us to charge AUC fees lower than the premiums that one would pay. So that conversation is very straightforward. It's if you would like to, for example, insure up to the full value of the assets that you hold, you can do one of two things: self-custody and then go through the pain of applying for insurance and then bind a policy, or say custody with us and pay AUC fees lower than the premiums that you would have paid in the first part.
And insurance is highly regulated around the world, so you need to work with a licensed insurance broker in order to obtain the coverage. And so step one is finding a broker, doing due diligence on that broker, understanding how specialized are they in digital asset, and how close to the frontier are they in getting this new area of risk properly covered by the insurance contracts. To Jacob's point, they're highly specialized financial institutions contracts to begin with, and then add on the layer of digital asset technology in relation to those contracts, and there's a lot of gaps in coverage that need to be addressed and negotiated. So there's a wide spectrum of brokers, and the brokers distribute and negotiate the risk on a client's behalf with the carriers and the insurance capital providers. So brokers do not take risk. We negotiate with the carriers on clients' behalf. Do you have anything to add?
No, I mean, the way you choose an insurance carrier is either two things. Well, one, the point is you want to get your claims paid, right? So there are a couple of different factors that contribute to that. You need to have a balance sheet that's going to be able to have money in it to pay your claim when it comes about. And then you want to be aligned on intent so that when you bring your claim to your carrier, they don't turn around and say, well, that's not the kind of thing that we meant, right, to cover. The reason why we have brokers is the same as with real estate. None of us are real estate experts, but we all need to buy houses, so you hire somebody who is an expert in the space to represent on your behalf. And it works the same way. Your insurance broker will advise you about different carriers, attributes and positives and negatives, but mostly you want somebody who knows and understands your risk and is able to provide you a policy or a product that is clear and it can give you comfort, right? The point is peace of mind or financial security. So those are the things that you want to look at in either a carrier or a broker who's going to advise you, or even whoever you do business with.
Yeah, I think it's pretty much all been said, but I mean, I would view this as distribution for commercial insurance it's a funnel. So specializing in commercial insurance, particular product, financial service industry, you get down to a fairly narrow group. So again, diligencing your counterparties. You should probably be diligencing all vendors you work with, including your brokers, in terms of, what is their experience that's relevant to your risk.
Are there questions too? I have more, but if there are other questions in the audience, please raise your hand, and I'm happy to take questions. All right. I find it kind of interesting that an area that I'm constantly pitched on how blockchain is endlessly trackable, everything is transparent, et cetera. The notion that you need a lot of insurance, or that insurance is a blockade to it, seems like, it goes against that premise that everything's right in front of you. Why would you need that much insurance? Why would it be so expensive when you have something that's so secure and so transparent? I mean, is there some nonsense in that notion that, in fact, actually the way the business really works isn't that transparent? I mean, how would you?
So I think it's an important thing to understand about a blockchain is that it is extremely secure at its core, if you will, that you should rest assured that if you're holding on to, say, a private key and nobody has learned that information, that an inappropriate movement will not occur. It is soft, however, in the periphery. And so this is a trade-off that is made relative to, say, other systems where they are soft in the middle, which is to say a external attacker may be able to penetrate the core and then cause a fund movement, but stronger in the periphery. One of the things that, say, Bitcoin did was push risk to the user of the service as a whole.
I think there's also something about the characteristics of it, right? If I have a bag full of money, that is very secure from getting stolen by somebody in a different state or continent, right? But it's very insecure because it's on my person and somebody, I'm a huge hulking man, but that, right, it's harder for me to protect. You put it in a bank. But with credit card is very secure in terms of you're protected against fraud. It's very easy to use everywhere, but you also lose that protection of somebody in another state or another country. So long as they have your number, they can steal your money, right? So it's sort of comes back and forth. Cryptocurrency based on blockchains, it's very secure against fraud and tampering and manipulation in the historical aspect, but the idea that your private key is more like a bundle of cash than it is anything else. So if you lose the key or it gets compromised, it is both very easy to steal and impossible to recover. So it's a bit of a trade-off, and that's what's understanding the risk profile about what your actual asset is, the risk you face, and what you need to protect against. It changes as you go through all sort of different aspects of the industry.
It's the first time in history where there's an asset class where a theft event can occur simply by having a copy of the private key. And again, we're seeing greater advancements in encryption that don't quite put as much focus on private keys, which is ultimately positive. It's an open debate in terms of, is this asset class more secure or less secure than traditional financial instruments? And at the end of the day, what we see large financial institutions looking for at this point is mature, sophisticated risk management behavior by native digital asset actors in the space, and fear of uncertainty, fear of how quickly this technology is moving, and the desire for obtaining absolutely as much protection as possible is truly what's motivating a lot of the large financial institution demand to see some adequate insurance protections in place. I think it's an open question of what is the right limit amount. We debate that every day, but a baseline of insurance is an important aspect of the maturing market infrastructure related to digital assets.
Yeah, I guess my only addition to that is I'll speak my own personal experience as I started seeing various types of digital asset companies cross my desk. The more I dug into the technology in order to be educated enough to try to make a market for this and go out and explain this to carriers, the more apparent some of the attributes for blockchains being used in this context are. I think you can eliminate a lot of things that historically have been, the financial service industry in particular has got a lot of outdated policies, procedures, infrastructure, a lot of things that can be improved upon from a security, from a user experience, from a tracking. Just having one immutable ledger in itself, as simple as that is something that can really be beneficial. As it matures, I'm sure the unknowns or the risk ends or the trade-offs for that will be better understood as well. The way I would just characterize where we're at today is that, absent of a real track record, until things have been thoroughly tested and stress tested, insurance companies are looking for these new risks. I think everyone up here is aware that technology is always going to drive that change and frankly make a lot of the analog businesses that we rely upon for our business, make them obsolete over time if they don't kind of grow and adapt. It's just a matter of, it's early days. We need more buyers, more track record, and over time I think that overall the technologies here are going to probably improve the safety, security, and potentially minimize the need for certain types of risk transfer. It's just a little bit early to say that for sure.
Yeah, and I'll use the last minute or so to give a shameless plug for insurance, right, with a history lesson. So insurance started in all places in a bar. There's a bunch of ship captains sitting around, and they said, if we pool all of our money, if one of our ships gets destroyed in a storm, that person can use the money to rebuild their ship and continue to contribute to the pool, right? So we can't make a market for insurance without your participation. So you say it's expensive, but compared to what, it's unavailable, but compared to what the benefit is that you're getting. So we need you, right, to teach us about your risk. We will help educate you about what insurance products are available, and together, hopefully, we can come and make solutions that's going to be additive and beneficial for everybody, right, in our pool together. If it's two ship captains sitting together, and the one guy loses his ship, the other guy's going to tell him to go pound sand, right? So it takes a community to build a market and a portfolio, and that's the only way that we can make the insurance work in a sustainable way. So it has to be collaborative and a partnership between both the buyers and the sellers.
So make sure to corner Chris when you have cocktail hour and tell him all your risks. And
He's going to write them all.
you guys can discuss that. Thank you, everyone, for listening to this. I think it was an interesting panel. Thank you, guys.